Hello and welcome to today's episode of Nucleus Investment Insights. Today's episode is called The Great Energy Heist. This year, we've talked a lot about the energy crisis in Australia, and every time you think things can't get worse, they do. The Resources Minister, Madeleine King, has signed a nothing deal with the energy companies that allows them to continue to rob the Australian people. This morning's developments in the sector have prompted a last-minute change of episode, so we'll run the episode titled The One Thing That Could Kill Inflation next week. Here to tackle the subject with us, we have our outspoken Chief Strategist, David Llewellyn-Smith. Dave, welcome.
Hi, Sam.
And as always, we have Damien Klassen, Nucleus Wealth Chief Investment Officer. Damo, welcome.
Thanks, Sam.
Thanks, guys. I'm sure everyone listening is looking forward to continue to hear the conversation unfold. Just a quick housekeeping message. Before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform, as our show's available on all the majors. You can also ask any questions for those of you watching live. We'll do our best to answer them during the show. And as always, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these in the episode at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, I'll hand over you, Damo, to give us a bit of background info on the subject.
Yeah, so we've obviously dealt with this a couple of times over the last couple of months, and the reason why we're so focused on it is because it is going to make a huge difference for anyone who's looking to invest in Australia for the next couple of years. So basically what we're looking at is an energy price shock. Australia is one of the largest energy exporters in the world. We have full capability to have much lower energy prices, as we're seeing in Western Australia, where we do have lower energy prices. So Australia absolutely has capability. Having said that, though, we're not using any of that capability, and arguably, we've got a bit of a fracturing in terms of the Labor government, in terms of some parts of it basically pushing the lines of the energy cartel, and other sides pushing the sides of the manufacturers and the Australian people. And at the moment, the ones that are winning are the ones sort of siding on the energy cartel. Now, if current systems go through, current sort of settings go through in terms of it, we're probably looking at about an inflation increase of about 3% to the Australian inflation rate over the next year or so, as these higher energy prices come through. Plus, it's going to be pretty devastating to the Australian manufacturing sector, and a whole bunch of companies in that are really going to suffer. So, for anyone who's looking to invest or has investments in the Australian stock market, this is probably the most key issue you get after rates and sort of global outlook. And so it really will be telling in terms of whether you look at Australia and say, look, I've just got to avoid it because of the settings in the energy sector, or whether you can tolerate some investments within the Australian market. And so for that reason, what's basically happened is we've had we'll go a little bit more into detail, but we've basically had an agreement from Madeleine King, the Resources Minister, signed a week or two ago, which is basically from my reading of it, is a complete rollover, and basically letting energy companies do whatever they want in terms of pricing, and giving no protections to Australian consumers in terms of prices and Australian manufacturers. And then at the same time, we've got the unions starting to step up, and they've obviously given a week or so for this to factor through. The unions and Ed Husic of both Ed Husic, who's a minister for helping with manufacturing, is starting to speak up and looking for changes. And so this will be quite telling in terms of where it goes at the moment. But with that sort of intro, I might hand over to Dave for more of the detail.
Yeah, thanks, Damo. I'll just add to that if the Labor government gets this wrong, then the shock could be of a much larger scale than what Damo's already described. So that's why we are focused on it. So let's do a little bit of potted history to begin, and then we're going to roll through pretty quickly into what's happening today. But it is important to understand where this has all come from. So it all started, pre and post GFC period, when there was an enormous kind of runaway boom in Australian LNG investment. On the East Coast in particular, it was focused on terrestrial LNG, that is fracking coal seam gas, and build a whole bunch of capacity to ship that gas as LNG in a place called Curtis Island to offshore. So what this did in effect was link the Australian gas market to the global gas market. And so when these plants opened in 2014, Australian local gas prices naturally rose to parity with international prices. But they didn't just stop there. They kept going up, and they went above international prices. And the reason for that was that the gas cartel that was running these LNG plants had dominated all reserves, and then created this situation where they controlled all the exports as well, and so they could more or less set the Australian price in any manner that they cared to. Australia allowed, in a sense, an energy cartel to form on its East Coast gas reserves, and it started behaving exactly how you would expect it to, which makes you wonder why we never did anything to stop it in the first place. But that comes to a very, very crucial point. One of the reasons why we didn't do anything, we actually don't have a regulatory regime to approve these projects, not an official kind of formal structure. And the regime that we do have tends to be environmentally focused. And these projects had to go through that approval process, and when they did, they all gave kind of undertakings that they had enough reserves of their own. And in particular, one of the projects that was being engineered by Santos found itself, it added a second train and a lot more capacity rather suddenly as this bubble grew, and immediately promised absolutely everybody that it had enough reserves. But the moment it opened its 2 trains, or its doubled capacity, it ran out into the broader market and bought up all the other third-party gas.
Actually, can I just give a little bit of an overview as well on that? So just to make sure that people are aware, in Western Australia, that's not the case. Western Australia does have a gas reservation system, and so gas prices stayed low in Western Australia, despite being a massive exporter and opening up a number of different plants over there as well, which is doing the same thing. This is basically saying that and that was largely oil and gas. So basically, gas fields, offshore gas fields. They were sort of tapping in terms of that. The East Coast ones tend to be some of it's gas fields, but a lot of it tends to be the coal seam gas. So basically, they frack the rocks in basically seams of coal deep underground, and then the gas comes up. And what Dave's talking about is that they spoke about. Yes, they will develop their own reserves, and then that's what they'll be exporting. And all this extra cheap gas that was in Australia already would be available for locals. But what's happened is they've actually gone and bought up everyone else's. So not that they haven't got enough to export themselves. So they're buying up all the cheap stuff locally and then selling it overseas at a huge markup.
That's right. And so we ended up with a higher gas price here than we did in all of our export markets, kind of between 2014 and leading up to 2017. So one more thing just before we move forward with that story is this is a very concentrated sector, gas in Australia. We're only really talking about 3 major operations that might have maybe 10 or 12 companies attached, but it's 3 major operations, so it's not diversified at all. It's a genuine cartel. We'll come back to the question of coal later, and I just wanted to flag that the coal sector is a lot more fragmented than gas. So we got to hang on, what order am I going to do this in? I got this back to front. Oh no. So look, I'll do so we got to 2017, and the fact that we were paying more gas for at home than we were in our Asian customers, despite the fact that we have to freeze it and ship it over there as well, it triggered something of an outrage by about 2017, and the Turnbull government of the day created what is called the Australian Domestic Gas Security Mechanism. Now, this was just a handshake agreement with the cartel that basically used moral suasion, if you like, political pressure, forcing the cartel to drop the local price. And so from 2017 to really the Ukraine war, the price, kind of oscillated around $10, below, a little above sometimes, a lot of the time below it. And during the COVID shock, for instance, it got very low, and even before that, it got quite low in Asia too. So the ADGSM, as it's now called, worked quite well for until this year, basically, and until we had the Ukraine war shock earlier this year, and Russia started to pull gas supply off Europe, which then triggered a mad scramble by Europe to find gas in the global seaborne market, which is where LNG is traded, and that drove prices crazy everywhere. So we'll have a look at how crazy these prices got. So as I said, once we had the ADGSM in place, we were oscillating around $8 or $10 for the most part. Then when we had the Ukraine war earlier this year and hit ourselves pretty cold winter, the local Australian gas price roared up to sort of $50 and $60. Now this was tracking global prices as well, and what I've got here is a chart called JKM. That's the Japan Korea marker, which is basically the North Asian gas price that our spot LNG is shipped on. This is probably around 40% of total volumes. The majority of it is still shipped on contract basis, which is measured by oil prices, and so those prices are a lot lower. It's probably around $14. So we're talking about spot prices here for the most part, because that's the one that matters to Australia, Australian domestic prices. So at the same time as it was going crazy in all of these LNG shipping prices, and our local price took off because, of course, we're now attached to global prices because we've got these LNG plants. LNG and thermal coal almost operate as a single commodity. They're basically competing over the same thing, which is fuel inputs into fixed energy or fixed electricity production. And so while LNG took off, so did thermal coal, and that has important implications because the Australian the national electricity market, which is Australian energy production everywhere, more or less, east of Western Australia, still uses quite a lot of coal, especially in New South Wales and Queensland, and it uses quite a bit of gas as well. And so when these two fuel prices went nuts globally, and then those prices came home, because these two markets are attached to global prices, our own electricity price went completely bananas, and did so really through the middle of winter. Has since come down a fair bit, but is still wildly higher than it used to be. We used to trade around $50 a megawatt hour. At the moment, it's still hovering around about 150. And the thing is about these two fuel markets, in international futures pricing, there's just no relief on these high prices for as far as these futures markets run, because I'm not sure that that's actually accurate. I think that maybe within 2 to 3 years, European transition off gas will actually start to drop this demand. But at least medium term, this shock just continues, and so those global prices will come back to Australia. So
back to East Coast Australia again.
Back to East Coast Australia.
Yeah, just to confirm that this
just
is not
to confirm. Yes, it's not in WA, because they have their domestic reservation and they don't use much coal anyway. So they're all fine and dandy over there. So that brings us up more or less to where we got to in the last few months. And, because we've had this huge rise in these energy prices, energy fuel prices, and then our electricity price as a direct result, that's put an enormous pressure on the government to do something about it, of course. And so what they did was go back to the existing regime that had been put in by the Turnbull government, that is the domestic gas reservation mechanism, and renegotiate it with the gas cartel. They haven't done anything about coal. In fact, they've hardly even mentioned it. And this is a major oversight that's going to come back to bite them as well. But for the time being, we're dealing with gas. And so it ended up that Madeleine King, the Resources Minister of the day in the new Labor government, was tasked with renegotiating this agreement with the cartel. And she's done a very poor job. She basically has done a worse deal than the existing one, because at the end of the day, the international price of gas is still sitting at about 60 Australian dollars, and she agreed to allow the Australian price to rise effectively to the international price. Now, at the moment, the local price is sitting at $20 or so. It was, as I said, at 50, but all this political shenanigans has driven it down. But now, basically, the Resources Minister tasked to fix this issue has made it a lot worse by giving the cartel permission to drive it back up.
And also as well, that the other, the original one had this idea of a net back, which is basically saying, okay, well, if it's costing, say, $5 a gigajoule to do all the freezing and sending it overseas, that the Australian gas price should be at least $5 below what the international one is. Whereas that's pretty much disappeared from the new one. I think the wording's gone to something.
I don't know. The new one,
they have an eye to it.
The new one doesn't actually makes explicit that they can't go above netback.
Oh, really? I thought it was.
No, that's why she's claiming that it's a good deal. The problem is that when the original netback price was floated as a possibility by the Turnbull government, it was $10. The netback price now is 60. Yeah. And so it does nothing except triple prices. So as Damo said, as things stand, because the cartel is yet to push prices back up to this $60 level, they're still sitting at 21, which is still nosebleed levels. Do not be mistaken. That is a price at which manufacturing will collapse, and power bills will go up roughly 60%. Power and gas bills, and that represents a CPI shock of roughly 3%. But if the cartel does what the new agreement says it can, then that will turn into a 10% CPI shock. Energy bills will double for every business and household east of Western Australia by 200%. They'll triple. So this is completely untenable if you have a political brain in your head, because obviously households are going to revolt. And if you're a manufacturer, well, it's just the end of your business. So you're obviously going to take that on in a political sense. And the unions have come out as well as the industry minister, Ed Husick, and declared this outright, basically, against their own government, said that this is just scandalous, ridiculous, farcical, and it's going to destroy everything other than mining in Australia. We've also had energy CEOs in revolt from, basically the energy retail side and the energy producers who have to use this super expensive fuel because they can't necessarily pass on all the costs. And so their margins are being destroyed, and they're all in revolt too. So, this new ADGSM is an absolute disaster across the board for everyone other than the energy cartels, which is, so in effect, what we've got is, I guess you would call a coalition of resistance that is forming to try and overturn this decision, and it is full of some pretty powerful players. We might even describe the position we've got to as overreach by the energy cartels, because the Labor Party can't ignore its energy minister. Ed Husic is quite close to the Prime Minister. It can't ignore all of the unions that are simply going to have, there's still nearly 1 million manufacturing jobs in Australia that are just going to evaporate. There are huge interests at risk here that the Resources Minister, Madeleine King, has simply rolled over like a steamroller. Now, this brings us to Madeleine King, and this is where this story turns from the outrageous to the completely comedic. And if you look at what she's been up to over the last month or so, the Resources Minister has signed this new ADGSM, and along with it came a code of conduct, which was supposed to address all of the terribly bad cartel behaviours that the gas suppliers have been up to. However, if I've supplied you here with a couple of documents, one is the cover page for the code of conduct, and it was clearly written by the lawyers of the cartel. Right? They've composed this code of conduct in conjunction with the lawyers and with the oil and gas lobby APIA. Now, that is entirely inappropriate, of course. This is
basically you're writing your own rules.
You're writing your own rules. I mean, and then along comes the minister and says, "Look at this great deal I've struck," and she just signed the contract that they wrote for themselves. So that's the first cab off the rank in terms of what Madeleine King's been up to and how badly she has performed in this for Australians and, well, pretty much everybody other than the cartel itself. And now in the last couple of days, as this has really started to explode, especially within the government itself, it's actually kind of developing into a civil war within the government. Madeleine King has disappeared on a gas and oil junket into WA. And I've supplied you here with her declarations of gifts and stuff that she has to declare to the Parliament. And over this week, she is unavailable basically to the media or anyone else for questioning because she's on a junket on oil platforms in WA. Now, paid for by APIA, the lobby, the same people who produce the code of conduct. So we just have to ask the question, has Madeleine King, the Resources Minister, been kidnapped at this point? She's unavailable to comment there. She's being represented by an underling in the national press who's just, blathering whatever, the company line is. And is Mad King, has she been physically kidnapped, morally kidnapped? Is this corruption? Is it literally a mob? Is this gangsters that have taken our resource minister and imprisoned her on an oil rig? Is she there voluntarily? We don't know because we have no access to her at this moment of national crisis. And obviously, this is just crazy, crazy stuff. It goes way beyond any kind of sensible probity for policy making. Ironically, on the other hand, you've got the Albanese government trying to put in an ICAC, which is an anti-corruption commission for federal politicking, and at the same time, it's got its resources minister running around on junkets whilst signing, self-regulation stuff that trashes the entire nation. So it's crazy stuff. This is why the revolt is intensifying, because it is so bananas. And so the issue is coming to a head, if you like. It's not going to go away. So, we really need to kind of figure out where it's going to go and what they're going to do for equities, but also for, fixed interest markets in Australia, because obviously this is going to have a huge input into inflation. And on that front, we had, as a part of this kind of crazy civil war that began this week in the government, we've had the Treasurer come out and say, yes, energy is the critical input into inflation over the next year. That's the thing that we're most worried about. The RBA, they're particularly concerned about what it will do to the RBA, as well as real incomes. And yet, on the other hand, you've got the Resources Minister making all of this worse. At the same time, the Treasurer has also said we can't possibly do anything about it. It would upset the miners. And you've got the industry minister just tearing the government to shreds, backed by the unions. And so you have this, chaos, basically. And then you have nothing from the Prime Minister to bring it all together. So,
and keeping in mind, just to put the Treasurer's position in context, is that he was sort of part of the government that fell. What was his position again? That fell.
He was an assistant treasurer.
Assistant treasurer, yeah. When they tried to put the resources tax in, and then got rolled by the resources companies, and so possibly has some PTSD from last time he was in and messed with the resources companies.
Well, there are labour sources openly declaring that he's damaged goods from that experience, and I think we can see that in his failure to address it and allowing it to become such a divisive issue. They actually had the perfect opportunity to resolve this through the process they started with commissioning the ACCC report, which painted a monstrous picture of what the cartel was up to, and then they've come out with a zero answer. And
it looked like clever politics at the time. I thought it looked like they were basically said, okay, let's get the ACCC to have a look at this. We'll use them as they're the black hat guy. They come out and trash the energy stuff, and then we come in with a solution. But instead, what's happened is they've come in and trashed it, and then they've gone, well, let's just keep everything the same.
Yeah.
Well, actually, not that. Let's make things worse.
And as a result, Jim Chalmers, the Treasurer, who I like to call Chicken Chalmers, is now daily describing his own policy failures. Like he's been rendered, almost his own critic, because he's got nowhere else to go but to just describe what's happening. So he keeps telling everybody how disastrous it's going to be while doing nothing about it. It's become very, very odd rhetorically as well. So what are the answers? What can they do to fix this? How can they bring these interests together and try and get them over the line and get some rationality back into things? So before Chicken Chalmers fled himself to, I think, an IMF meeting this week, he mentioned in the press that they might focus on the code of conduct, which, as we know, was composed by the gas cartel. Now, that's not very useful for starters. If they were to insert a price guide into the code of conduct, there is no legal obligation for the cartel to match it. There's actually no legal obligation in the ADGSM either. All of this is working as a handshake and a moral obligation. So it doesn't really fix anything, and I doubt that the cartel would pay much attention to it anyway. But that might be the next cab off the rank, if you like, as a solution, as a short-term attempt at a solution that I don't think will work. Now, there's a secondary issue here that I keep coming back to without really addressing much, and that is coal is also a big problem for the Australian electricity price, especially in Queensland and New South Wales, where coal is much more dominant in terms of energy production. It's the same in Victoria, but it's brown coal, which is not attached to the global market. So those prices are contained. But the black coal that's used in New South Wales and Queensland, those prices are set globally. And so even if gas is fixed, it will certainly help Victoria, South Australia and Tasmanian prices, electricity prices, but coal will still keep New South Wales and Queensland electricity prices too high. And so there's another layer to this that the government hasn't even encapsulated, let alone addressed yet. Coal will be much more difficult to do as well. It's much more fragmented, so reservation is much harder to do in a practical sense, finding a mechanism that actually allows you to do it. So where does that leave you? There are very easy solutions to all of it, but they come back to Damo's point of having a government that is terrified of miners, because the last time the Labor Party was in power, they virtually got thrown out by a mining revolution or a mining coup. because of attempted taxes. So, they're going to have to do something, but what they're going to do is just difficult to fathom. A lot of people are calling for super profits taxes. That's what the UK has done. Europe is also looking at that. So, there are precedent for them to follow, but there are very big problems with super profits taxes as well. The number one being in today's environment, they are actually pretty inflationary, because you allowing the energy prices to spike, which will give you the inflation, and then you're giving the money back to people, which is more money to spend. And so you're actually doubling down on some of the inflationary impacts of the problem. So that's got a very big problem in it. There's a very good solution to all of this in export levies, which basically you just set a price for both gas, LNG, and for LNG and coal. You do pre-Ukraine war pricing, where you just set a price for both of those and say, this is the price, that is a fair return on investment. And anything above that, any revenue above that, is immediately just goes straight to the National Treasury instead of to the companies. And that does a number of different things. It channels an enormous revenue stream from the war shock into the Australian Treasury, which is appropriate given that it's a windfall profit based on a war that the companies really are not entitled to, and the Australian people own that resource and should get that money. But at the same time, it crashes the local price because you've erased the connection to the international price. And so that is just a win-win-win-win-win. It also doesn't affect volumes. So, this notion of sovereign risk evaporates. So that's just a brilliant solution. The problem with it is, of course, you will be erasing the super profits of both coal and LNG. And so you'll have a war with those interests.
And having said that, though, you're erasing the local ones. I'm assuming this it's not priced on what's exported, though.
Oh, no, it is.
Right. So you're saying do both imports and exports?
Yeah, it's an export levy.
Export.
So you take it all.
Yeah.
So that this is their worst nightmare, basically, for miners, but it's the best solution as well. So, and it's actually an appropriate solution too. But it's the kind of thing that keeps the Treasurer Chalmers up, into the wee small hours of the night and makes him reach for the revolver. So I'm not sure we're going to get there.
Well, and I'd say as well, the intermediate one though is one is you say there's a super profits tax on local. Well, you let exporters they can export what they want.
No. Yeah. Super profits taxes are on everything as well.
Yeah.
And the other solution, of course, is the domestic reservation. But as we discussed through this, it's quite difficult to do that on coal, is the problem. So. The export levies are absolutely the A1 solution, but they're also politically the one that you're going to pick the biggest fight with the miners. I actually think it would be a great idea to pick that fight. And if you've got the nuts to carry it through, I can't see why you wouldn't win it hands down. We're talking about, coal miners and a gas cartel. It's not the same as the super profits tax that was, aimed largely at iron ore, which is, kind of national champion stuff in Australians' heads, and so there was some sympathy for the miners in that case. In this case, it's just globe-trotting, globe-destroying evil, and just bloody take the money. I just can't see the downside, to be honest. Anyway, they're cowardly, and I'm not sure they'll get there. I think the worst case is probably the most likely outcome here, which is what they may end up doing is energy subsidies. And they may not even get a super profits tax to pay for them. Now, this would be the worst case scenario because, in effect, we would be issuing debt to pay the cartels whilst boosting inflation. Because, government's got to find the money somewhere to offset the energy bills and to subsidise them, send out checks to households and businesses. That's either going to come out of higher taxes or new issued debt. And then all you're doing is in effect channeling that money to the energy cartels, whilst people will have more money to spend, and so you'll make your inflation problem worse. And so, unfortunately, I think that's probably the most likely outcome, because it's politically the most easy, where you just say, okay, well, we'll just pay people so their bills aren't so bad. But it would be a horrific result. So those are your policy options. We're obviously going to see some kind of resolution to this in the near term.
Well, I don't know about obviously. We're hoping.
Well, no, I think we're going to have something, because you can't have a government in civil war over something as critical as energy. I mean, these days the press will eat you alive if you've got any kind of conflict within your government, and this is extreme.
Well,
conflict.
But the press hasn't even been reporting on it. No,
I don't know, not yet, but they will.
Yeah, I hope so. I hope you're right.
I think they will.
My concern is that at the moment you've got Ed Husic on one side, and Chalmers and Albanese in the let me just see if I can do nothing and hope this goes away. And Madeleine King's already signed the thing for the other side. And so,
look, I take your point.
Sort of had this view that, look, I'll hope it goes away. And what do we need to do? Do we need to replace Ed Husic with somebody more, less of a backbone?
Well, that's certainly possible. He could get the chop. But that said, I think the coalition of resistance here is the most encouraging thing. Like it's not just Ed Husic, it's the unions.
Yep.
And perhaps even more importantly, it's all of the CEOs on the receiving end of this. And this is, at the moment, it's only the energy CEOs. Once this develops more of a head of steam, it actually should incorporate everybody else in the Business Council of Australia. They should all be up in arms. They're all going to get stuffed by this. All their margins are going to get squeezed. And demand's going to get trashed, and it's going to hurt both top and bottom lines for everybody other than the cartels. So, I mean, I could be wrong, of course, but I think that there's a sort of irreversible head of steam coming here in the revolt, which, will need redress, I think. But yes, you're absolutely right. I mean, it could all just disappear again.
But as you said, and it takes a while.
And they could kidnap Ed Husic next.
Yeah, well. and the thing is, we're in the phase now where spring is the best time for renewables. Like we don't have much heating, we don't have much cooling around Australia. We've usually got lots of sunshine, so we actually generate a lot of renewable energy, and so it might not come to a head, and then you hit summer, and you probably. Depending if it's not I think we're looking at a relatively rainy summer, aren't we? So maybe there's not a lot of heating, not as much heating as you might need.
Yep.
And so maybe the problem doesn't really come to a head until next winter. And if it does, it comes to a head where by June, July, maybe people are finally getting the bills that are and suddenly getting this massive shock to the, oh my God, my electricity bill's just doubled. Tripled. I guess what I'm saying is, if there's a let's just hope things get better, which is I think probably the default for most governments when faced with a crisis, is it might take a long time.
It may well. Who can say? Yeah. I mean, that is I guess the well, that's the status quo, isn't it? So, that may be the safer bet. I'm not sure. But I just am seeing a lot of.
We have to be watching it. Is it regardless of whichever way it's going to go?
There's definitely a coalescence of interests against it, and they're strong. They are powerful. So I can't see it falling away.
And they do
entirely
have the moral right on their side.
Well, they do. And the more the bills come through, the more upset the polity is going to be. So anyway, so investment implications. I mean, in terms of immediate stuff, I think I agree with Damo anyway. It's probably not a short-term issue for markets, Australian markets, because I think, the cyclical pressures coming to bear globally are going to outweigh this anyway. And maybe that's the tipping between the debate Damo and I just had. Maybe that means that there's, it'll take some of the pressure off enough for them not to do anything immediately. But if it's left to fester for very long, it is going to be, a structural shock for the economy. Now, that probably takes two forms. The first will be manufacturing will collapse in Australia. It's just not going to be competitive under those circumstances with these levels of gas prices and electricity prices. It just will go out of business. So we'll see a lot of shedding of jobs in that sector.
And to put that in context, we usually had a quite a low energy price relative to, say, Asia. So Australian, not as low as the US, but certainly lower than Europe and lower than Asia. And so that was sort of a bit of a competitive advantage that Australian manufacturers who were using gas sort of had, was that, we had this locally cheap energy. And now we've basically gone from, $5 to $10 a gigajoule to $60. So you've basically for some of these guys, it's their biggest input has basically gone up 10 times in terms of the cost.
That's right. So yes, we'll be seeing that. Now the other big one, and in aggregate probably even larger, at least in sort of dollar GDP terms, is the impact on inflation. At current prices, it's manageable, and the RBA will trim a lot of it out anyway, because you'll see these will be, the very large movements in the CPI that they trim out of core.
And so when David says they trim it out, so what the RBA is basically got, there's two, there's lots of different inflation measures, but one measure is what is real inflation, what's their aggregate inflation, but the other one is what does the RBA think they can influence, and that's the one where they trim out large sort of extremes, and that's where a lot of these wouldn't end up. So that
so that's trim mean. The problem is, though, energy being an input into everything, is that the 3% that we're talking about at the moment is comprised of 2% of energy and then 1% of spillovers. Now that could be more or less, but the spillovers will be very difficult for the RBA to trim out. In fact, they won't be able to trim those out, meaning that every business that you deal with will be looking to pass on its rising utility bill and its prices. So the RBA can trim the initial shock out, but not the secondary effects, and they will be bad enough.
And also the big issue, obviously, is that this is effectively an extra tax on Australian consumers. So for your average household who's just had their their mortgage, or about to have their mortgage reset to a much higher level, then to go, you also need to pay an extra couple of grand a year in energy costs, will affect what they can spend on in the rest of the economy. So a big hit to demand. Yeah.
Yes, it will, and that will be made even worse by, structurally higher interest rates, which is the other impact of this if it's allowed to run, which would mean lower house prices, of course, versus alternative scenarios. And so that gives you a kind of combined household industrial weakness over the medium term that potentially becomes a structural adjustment versus our old model of selling dirt and then leveraging that dirt into house prices to drive services demand and industries. We would in fact instead have some structural deflation in that model, where house prices can no longer rise because interest rates are shunted higher by, an energy shock that has medium-term implications. So at this point, I wouldn't say we're there yet, but we're definitely on that path. And if the kidnapped Madeleine King's New Deal is allowed to run, that's where we will go, definitely. And of course, we then have to factor in the question of, will the government do something about that? So this is why it is an existential question for Australia, and we keep returning to it. So short term, you probably don't need to be too concerned about it, but over the medium term, it's enormous and absolutely vital.
Mm. And in I guess in a big picture sense, what's sort of driving investment sort of strategy for us is, okay, we've got this global slowdown coming down the freeway. So we're looking at higher interest rates and strong chance of recession in a number of countries, falling earnings, and so we've got a term sort of baked in. Now the question is, as that sort of comes to its as that sort of comes to a conclusion, and you get equity prices falling to more reasonable levels, and you start talking about what are you going to invest in for the recovery. That's where this really comes into play, because without this, you sort of go, okay, well, look, there's a number of factors. We look at Australia, and we actually we're from a renewables perspective, we've actually got this huge benefit. We've actually got a lot more renewables than a lot of others. We've got a lot of other countries. We've got these great solar resources. There's all these actual benefits you could see for Australia coming out of this. Without that sort of encourage you to have a bigger investment in Australia. But if you've got this overhang of the rest of the world will be recovering while we're still copping it from higher energy prices, then all of a sudden your investment needs to switch as to what assets you're buying, sort of coming out of the downturn over the next few years.
Fantastic. Thanks, guys. So now we have our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, has Madeleine King been kidnapped? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. I think that was your one, wasn't it, Dave? You must have come up with that one.
I did, yeah. Well, I think it's a fascinating question.
Yeah, excellent.
I think the answer is yes. It's just that we need to define what kidnapping is.
Yeah. Great. So I just want to let all the viewers know as well that this coming Wednesday, we've got a live in-person event. It's called Meet the Managers. It's a little bit different from our podcast. So it's at 6 p.m. on the 19th of October in our Melbourne office in Collins Street. Damien, I'll hand it over to you just to let the viewers know a little bit more about what the presentation's about and what they can expect.
Yeah, sure. So look, we've titled it, "Will this historic bull market end with an historic bear market?" But really what we want to do is take a bit of a step back and really look at the broader picture. So week to week on the podcast, we obviously deal with current issues and what's happening. What we're really trying to look at from this presentation is, look, how can you put portfolios together in a big picture sense, and whether you're going to use our expertise or whether you're going to use your own thoughts on it, and how can you use some of our funds within those to sort of put portfolios together and sort of this overarching concept of how you should be looking at your structuring your portfolio, and then how are we going to play it. So I guess what I'm hoping is that, regardless of whether you agree with our thoughts or disagree with our thoughts, there'll be something in there for you to talk about in terms of how to structure your portfolio. But then again, what are we doing in terms of the longer term picture, and what's our playbook for how we're looking to treat the next couple of years in terms of investments as a big picture sense.
Nice one. Thanks for that, Damo. And we'll I've just posted the link in the chat there, so you can register for the event there. So yeah, we'd love to see some people come along. It's the first live event we've done since COVID, so it'd be good to, an opportunity for everyone to come down, listen to something a little bit different, and we'll be available to have a bit of a chat and meet any potential clients or existing clients. So please sign up. We'd love to see you there. So yeah, you got anything else to add, Damo?
There's a question I think from Jude. It's well worth sort of looking at.
Yes. Okay. So Jude's asked, how do you see the Aussie bond outlook in the Nucleus Wealth growth portfolio? Some of them are having a tough time at the moment. She also says, love the show and the fund.
I think Jude's a he, but there's a
apologies, Jude.
I think the key bit for bonds, particularly the long-term bonds, which are the ones that have been hit the most, is that, look, they are determined more by global events than they are by Australian events. So the short-term ones get affected by these this discussion we've been having about, if we've got facing higher inflation or not within Australia. The long-term bonds really are affected by the foreign bonds, and in particular the US bonds. And so the question for these is, will we start to see more of the recessionary indicators coming down the line? And as that comes and central banks start to ease up, is when you see bonds perform. So we saw actually when the Aussie bonds, when the RBA only raised rates by 25 basis points rather than 50, there was a massive effect on bonds globally, and they all shot up in value. Then we had the US results come in, US job results come in better than expected, and you sort of reversed a lot of those gains. But I think that was a very good indicator of, look, when we do see signs that central banks are pulling back, the movements in bonds are going to be very sharp and quite quick in terms of a reversal. So look, I guess our hope was that you would have seen these effects before now. I think now is probably not the time to be abandoning this that trade. I think there's I guess the thoughts we have is that you're either on the part where inflation is going to be embedded and particularly from wages, and we'll go into more detail on that next week. But if you've got that view that inflation's embedded, it's going to be in with us for years, and central banks are going to have to raise rates way higher than what they are at the moment, then the bonds is the wrong call. If you're more of our view that actually the signs are all turning, that we're in for a relatively big downturn, and that we're going to see recession signs continue to emerge. So basically all the leading indicators have turned that way, and we're starting to see some of the coincident indicators turning that way. Then the bonds is a trade that's sort of yet to come good, but we do think is getting pretty ripe. Dave, I don't know if you've got any other thoughts on that.
I agree with all of that. I mean, we've been dollar averaging into those bonds as they've sold off. We were a bit early because we were
way too early.
We were looking at in pre-Ukraine war, we were already averaging into some of those bonds because we could see that the global goods inflation that was causing a great deal of panic was going to reverse pretty quickly. But then we got this second round of inflation shock that came out of the Ukraine war and delayed that. And so we continued to average in after that. And it really is a play on the end of cycle. I think even if you're hawkish about a structural shift towards inflation in the global economy and or Australia, then you still have to factor in what I think is the base case, a strong base case, that we're going to see a deflationary shock in the short term as central banks squash it, which may rebound quickly afterwards. But this is a play really on that end of cycle. That was what it was always about, even though it's been delayed and pushed higher than we expected. So I'd agree with Damo that I wouldn't be getting out of that trade right now. In fact,
yeah, and actually the one thing we have discussed is is the is the worst case for us, not the worst case, but is a risk case for us that actually the bonds don't start rising until we see equities at the same time rising. They've both been going down together. Do you actually see the bottom of the cycle and then both bond yields are falling and equities are rising at the same time? Now that might be the case, but I don't think so. I do think there will be a gap between the two in terms of you'll get this recessionary signals. You'll still have falling earnings, and so you'll see the bond rally, and it might be that the equity rally comes shortly after that, as you sort of as equities as the sort of earnings starts to bottom. But we still do think there will be a reasonable period of time enough within that you'll see the bonds perform first, and then it'll be time as the bonds are performing, it'll be time then to roll out of that and into equities once you start seeing central banks and governments sort of start to reverse and provide support rather than headwinds.
Yeah, I mean that's the ideal. If you end up in the circumstance where they rally together, well, you're okay anyway. But the typical cycle would work in the way that Damo's describing. So that's what we're positioned for.
And I think as well, look, obviously we've rolled right out of equities and into bonds, and bonds obviously hasn't been a good performer for us over the last 6 or 8 months. They have still outperformed the equities we were in, I suppose. So there's, without sort of, ideally we should have actually been in a lot of the shorter term bonds and played it from that perspective. But I think there's there's certainly an element of we think we nailed the currency call, we've nailed the equities call. We got the bonds one wrong, but we think that the bonds one is wrong in terms of being too early, and we think that will come good, and then take it back into the next cycle from there.
Yeah.
Nice one, guys. So that almost wraps us up. Just want to thank you, Dave, Damien. I know there's lots of people that appreciate you guys talking about this topic, raising awareness, and it affects everyone. So it's just want to say thanks.
So thanks, Sam. Thanks, Dave.
Awesome.
Yeah, thanks,
so we do welcome your feedback on this podcast, especially in relation to suggestions for future topics. If you do have any ideas, please drop it in the comments section below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with myself or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with us, you can also follow us on all social media. So I will have put the invite link into the comment section, and we'll also have them in the slides after the show. We'd love to see you along at Meet the Managers next Wednesday at 6 p.m. in Collins Street in Melbourne. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.